Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day everyone, it's Garman here, editor of Smart Property Investment, back today with another episode of the Smart Property Investment Show. And this is an episode that I've been excited for the last, I think it's been in my calendar for about a month, and I've been excited for it because my guest today is, he's an expert in many fields. Of course, he was a broker, then a business coach, an investor, now a buyer's agent. It's Ross Le Quesne, head buyer's agent at KHI Property Partners. Ross, you're going to be getting all the hard questions that I've been saving up for the last few months.
Oh, awesome. Can't wait to unpack it all.
Some just the beads of sweat. No, easy questions. It's always good because obviously we're in a very changing macroeconomic environment, so good chance to have your expertise. And an old hat, Alex Whitlock.
An old hat. I've been called worse.
Oh, well, I'm worried that even factored in.
Your intro to Ross is very interesting because I've known Ross for many, many years. And he is a buyer's agent, but he isn't a buyer's agent. You know, I'll talk about that shortly. So, I've known Ross for, it's got to be close to 15 years now. Ross has been a trusted advisor to me and to many of my friends. Phil, as well as, hosts the show. And yes, Ross is now operating in that field. But he's very, very different to any other buyer's agent that I've encountered. So part of the reason Ross is here, good friends and very, very trusted advisor over many, many years. But, I've been on a buying journey in my favourite city in the world, which is Melbourne. I'm a massive, massive fan.
Favourite city?
For investment purposes, yeah. I've always liked Melbourne. My first investment properties, the first 5 places I bought were in Melbourne. And I'm back in Melbourne now. And I'm not, don't work on the sort of the investment side of media. I do work in media, but I work on the mortgage broking side, and I have to digest and analyse all of the results that come through and all the various metrics that I'm sure yourself and your colleagues get. And Melbourne has just looked red hot to me for about 18 months. So, but yes, Ross is now a buyer's agent. It's funny though because Ross is he's a real estate and buying professional is what I would call Ross, but he always has been.
I mean, when you touch on that many different facets, to have the mortgage broking expertise, the business expertise, the investing expertise for yourself, and truthfully, and I think it's reasonable for the three of us to look into this a little bit. When you scratch the surface, and you can get your real estate licenses after a few days, and you can work as an assistant buyer's agent. There's a lot of people that are advising people on their property journeys that A, have never done it themselves, but B, don't have that level of expertise, especially when you're dealing with financial products like broking. Look, to kick us off, yes, the name of the game today is Melbourne and the Victorian market. But Ross, while you're here, can you give us some insights into some of those macroeconomic trends that we're seeing at the moment? Migration, supply. What are some of these factors that are really implementing or impacting the property market now? What are the most important in your eyes?
Yeah, there's a number. You touched on a few, right? So one, we look at historical growth. And since COVID, over the last sort of 5 years, there's been massive changes in the market. You've seen, markets like Perth, Adelaide, Brisbane all grow by more than 80%. And 80% is massive, right? It's not just a small level of growth, it's a massive level of growth. You see markets like Sydney have gone by about 40%. And then that leaves, we've been talking about Victoria, but Victoria has only gone by about 15%. Right? So you look at these markets that have had massive levels of growth, and we say on average over the last 25 years, 6-7% is sort of average. So that'd be 35% over a 5-year period. This is 80%. So this is more than double your average level of growth. So quite often when I'm having that conversation with clients, and I love the quote by Warren Buffett: "History doesn't repeat, but it rhymes," right? And so in terms of, it's not so much the time in the market, it's the timing in the market, right? So do you see that we're going to have, another 80% growth in some of these markets that have already grown? Right. So that's one of the things, that we look at around timing the market. Then we look at, well, where is the population growing? You mentioned migration. Where are people moving to? And, the big areas of where the population growth, and there's been record levels of migration over the last sort of few years, and where they've been going is New South Wales and Victoria. Right. So you've got, and then you look at some other factors in the sort of broader economy, like construction costs. Construction costs over the last 5 years have increased by about 80%.
That's wild.
Right?
Yeah.
And so, what this is playing out means that, the numbers aren't stacking up on a lot of residential developments because the costs have increased to the point where it doesn't make sense for developers who are land banking to build those properties, right? So then what we're seeing is we're falling well short of the required numbers of dwellings. I think the government put some stats. You probably know what they are in terms of how many dwellings, and it's running well behind where we need to be. So we've got then a shortage of rental properties. So they say a balanced market is about 3% vacancy rates. You look across, the nation, and we're looking at, less than 2% in many markets, and many parts of, Victoria and other places is less than 1%. Right. So we've got a severe shortage. We're not building enough. And there's, comparatively, in terms of where growth has already been, Melbourne is looking like it's on sale at the moment.
Do you know what, Ross? This reminds me, we'll go back to sort of I mean, I know you've been involved in property investment from the financing side when we first started working together back in that sort of 2011, 2012. And back then it was Steve and Victor who were buying from infill, and it reminds me of the market out west in Sydney. And you kind of look at the price of properties out there, and as investors, we looked and we just went, "There's a massive opportunity here." And I remember looking at the prices, in some of those suburbs that we bought in, and I can remember walking away. I'm sure it's been talked about by Phil or various other people on this podcast. Walking away from from sort of 3-bedroom houses that were for sale there for like a couple of $100,000, and there's something about Melbourne that smells to me. And I felt this for a while when I've read the data, and I've just seen Melbourne as one of the world's most livable cities. We all get a bit conditioned living in Australia. We go, Melbourne, Sydney, Brizzy. On a global scale, Melbourne is a highly attractive destination, and to see it falling so far behind other wonderful capital cities, lovely places to live, but just from the economics of it, I just smell that once in a cycle opportunity, which is why I've gone back buying in Melbourne over the last 12 months. But it's just got shades of that, hasn't it?
Definitely. I remember that market, and I was investing myself back then. And you get the feeling, and whilst the stats, if you look at the stats and the CoreLogic stats that came out with their latest housing pack, it's not showing in the numbers yet.
No, it's not.
It's not.
Of course it isn't.
It's not showing in the numbers, but the on the ground truth, we're seeing it. Right. The perfect example was on the weekend a property in the northern corridor of Melbourne sold for $1,068,000, right? And properties in that area have been selling between sort of $850,000, and so this was massively over the market, and just shows there's that level of heat where people are now paying some silly prices for properties. And it was exactly the same back then in 2011 and 2012, as you mentioned, in Sydney. And I just thought, it doesn't matter. You've just got to get into the market.
You've got to get in.
Because it's the momentum that's going to give you that.
But here's the funny thing, and hindsight is kind of a wonderful thing. And we stood there at auctions, and we stood there, in front gardens, and you'd be bidding on a property, a 3-bedder on a 400 or 500 square meter block, and you go. And we'd have our walk away price, and we'd walk away, and it might go for you'd be talking back then of places going for $223,000, and we go, right, that's it, we're done, we walk away, and it might go $5,000 over. You go back and you go, hey, why wouldn't you have gone over the $5,000? But the bottom line is you can't predict the future, you know. So even though I feel that and this is, look, I'm an investor, I'm not involved in any kind of property recommendations, but even though I look at Melbourne now particularly and see this opportunity that we've seen take place in Perth, and that was a little bit less predictable in many ways, you know, you still got to be discerning. You've got to have you can't just go in there and buy at any level or any price, because the valuation's still got to stack up. It's got to be right for today, you know, and hope that it's right for tomorrow.
Yeah.
So on that note, what are some of this is a question for both of you, because Alex, you're very active in the Melbourne market. We'll start off with Rosso. What are some of those go, no-go characteristics of buying in Melbourne? Surely there are areas that are more primed for growth, areas that are less primed for growth. Maybe there's new supply coming on board.
Definitely.
Can you take us through that?
Yeah, definitely. And you mentioned supply, and there is still areas in Melbourne where there's still, you know, like Sydney, for example, you've got bordered by the mountains. So that sort of urban sprawl can only go so far. You know, one of the things that's different in Melbourne is, you know, there's plenty of land, right? And you look, there's
Goes
still
on as far as I can see.
Exactly. There's plenty of land, and so there's still areas that don't have scarcity of land, right? So, you know, until that market is fully built out and developed, you're not going to see growth, right? So it's not as easy now to just pick a pin and go, I'm going to invest in any suburb of Melbourne, because you know, not every suburb has the scarcity of land that's going to give you that long-term sort of growth, right?
You've got your price points as well, right? You know, like in any market, you know, you've got different sectors of the market, and there's opportunities at the lower end, there's opportunities in the midsection, there's also opportunities at the top end.
Exactly. So, you know, and affordability has been driving the markets. You know, if you look at the macroeconomy, we've had higher interest rates in terms of, you know, record high interest rates. Yes, we've had a couple of rate cuts and we've seen a little bit of relief, but historically speaking, we've still got high interest rates. So with high interest rates becomes affordability, right? In the latest sort of CoreLogic stats, it was that middle tier of the market that had the strongest growth, which changed from being the lower sort of tier.
Give us a price break. What would you call middle tier in terms of kind of dollar value?
Yeah, so probably in Melbourne, you're probably looking around about 700 to 900 of range as being sort of a middle tier. Obviously, yeah, it depends on sort of where you put it, right? But in terms of, I think that's a market that we're seeing, you know, really strong sort of competition in that level. Obviously, the higher levels where the affordability, as rates come down, you will see, you know, it shift in terms of for those markets as well.
Are you seeing it? So I'm doing your job. I'm just curious.
I'm racking up the questions.
So the question I was going to ask, and I'm just, you know, interested is, you know, are you seeing much split between houses, you know, and apartments? Are both markets moving there? Are you seeing?
Yeah, I mean, and this is a really interesting one in terms of the stats when you look at the differential in prices between houses and units since COVID.
Yeah.
Right. So in COVID, it caused a massive shift. So somewhere in like Melbourne, the differential between the cost of a house and a unit was probably about 30%. Right now, we're seeing it above 50%. Right, so the land value component of a house, and you know, and to your point, when we're looking at the value and looking at places to invest, it's the land component that holds a lot. I've invested in my own portfolio in both houses and units, and I've had some great performance across both. But generally, it's the houses that have outperformed. And when you look at it from a supply and demand and a scarcity perspective, if you own a block of land and a larger block of land, you can have the benefit of being able to redevelop that. And we're seeing a lot in different areas of Melbourne at the moment. They're changing rezonings, especially around, you know, train stations and so forth, where you can build more. Whereas if you've got a unit and someone decides to build, you know, a 10-story, you know, unit block, and there's 100 units in that development,
Swamped.
your scarcity on 2 or 3 blocks of land has now changed totally, right? The dynamic, the supply, the demand, the rentability of your property changes overnight, right? So, having that land component is key to success in terms of investing, especially with what we've seen that's happened in COVID, where the price differentials have changed so much.
One question I do have is, and Alex, you highlighted it before, which is, Melbourne kind of just keeps going. Now, I'm from Sydney. I go to Melbourne frequently, every few months, really. And that's kind of how I picture Melbourne. It kind of just goes on and on and on. It's big urban sprawl. Can I get some characteristics into what some of those new development areas, some of those new suburbs look like from my frame of reference? There are parts of Sydney, which is why even if Sydney keeps expanding, the infrastructure is not necessarily keeping up with it. I mean, there are new areas, new development areas in Sydney where it's like, well, your closest school 30 minutes away, your closest train station's an hour away. So realistically, the underlying value of the asset, well, it's not as potentially good as the price is saying. Can you give us some insights into those new sprawls? Is the infrastructure keeping up?
In some areas, yes. In some areas, no. Right. So it's the same old thing around the infrastructure. What is the infrastructure? What is your access to a train line? What is your access to amenities, shopping centres, those types of things? So that adds to the value, and because at the end of the day, what drives the market is owner occupiers.
Yeah.
Right. So as property investors, we are price takers. So, you as a homeowner, where would you want to live? Right. And what is going to drive your decision on where you want to live? And the great thing about property investing is we've all lived in a house before. We all know what's attractive. We all know the types of property that we'd like to live in. So, when it's not rocket science when it comes to sort of making these sort of decisions, that you want to be close to amenities, obviously within walking distance of shopping and train stations and transport, and all of those things is going to affect the value of your property long term.
Which is to the point earlier, which is, okay, Melbourne, we expect it to be a booming market, but you can't just take a dart and throw it at the map and expect that wherever you land is going to make money, because if you are hours away, your return probably isn't going to be as good as somewhere close to the amenities.
Here's the thing, right? If you've got a 30 or a 40-year view, of course you can pick anywhere and it's going to go up in value. But the reality is that it's not going to be equal to more strategic purchases. And depending on what the goals are of investors, some people have got shorter term goals. So they may be looking to they want growth now so that they can leverage and then maybe purchase again. And then it can slow down, So depending on what your goals are, you pick and choose the suburbs and the areas you're going to invest in to meet those short and long-term goals. But and it's not even just a suburb though. Look, to a certain degree, maybe you could pick any suburb. It's about the asset that you buy within that suburb, and there's still plenty of very, very bad purchases that you can make. You can make bad purchases in good suburbs, right?
Oh, definitely. It's choosing, choosing wisely in terms of the type of property, and that's where the expertise of a buyer's agent can save a lot of people time and money, because we understand those. But
even go back to when you weren't a buyer's agent, and I still don't see you as a buyer's agent, even though that's what you do. But I'd consult you always on every purchase, and you were the guy sorting out the finance, But I valued your opinion.
So Ross was your mortgage broker.
Yeah.
Yes, yeah.
And Ross was referred to me by my accountant. So it's interesting the way that things go. And Ross was referred to me. Aussie franchise, a wizard. Aussie. It was
Aussie.
Probably Aussie then. Aussie franchisee. My accountant said this guy's really good, and then started working with Ross, and then Ross referred us to a buyer's agent, and that's kind of how things went from there. But I'd always, because you knew your stuff even back then. Because Ross was, yes, he was a mortgage broker, but he understood property, valued property, bought property. So I'd go, oh, what do you think of this, Ross? And he'd look at it and he'd go and he'd have a look at the desktop val. And, his opinion was as important as the buyer's agent's. And the difference being is at the time, Ross was not going to go out there and negotiate. We'd got a referral partner who went and did that for us. So
Now talk us through, you two recently partnered on a purchase. Can you take us through the methodology, where you were looking, how the partnership happened?
So Melbourne was somewhere that I got my sight set, and it just so happened that it was at and around the time, I can't remember how we first got chatting, but it was at and around the time that Ross was. Your business has been going for a while now.
Yeah. So at the time, it's been going for about 6 months, but I think this was in a couple of months back. So,
So I've changed, sometimes painfully. We talked about in a podcast, I won't go into it in a lot of detail. Acquisitions, purchases that I've made, to then look at, sort of recycling them and to consolidate my portfolio, which is a fancy way of saying buying more expensive properties and have fewer, sort of lower price properties. So part of that strategic move in Sydney was to buy in Surrey Hills and in Paddington, then out in the beaches, at Avalon. And then I've also got a regional place sort of just outside of Port Macquarie. And then looking at Melbourne, I kind of leapt in very quickly a year ago, and I just bought something very, very quickly in a nondescript-ish northern suburb. But so just to give a little bit of context, it was a fairly, you had to look at it, Ross, fairly vanilla, 4-bedroom, smallish block, newish build, 2018, I think it was built.
This one near the airport.
That's one near the airport, right? Yeah, here's the thing, right? And I'm not recommending any suburb, but I bought there less than a year ago, 9 months ago. So since I bought there as part of the process of getting finance together for the latest place, and I'll talk about that in a second. So the val, I bought it for 670. The bank val has come back in at over 700,000, which, all right, great, 30 grand. But 30 grand in that period of time, a bank you would expect to go, yes, it's still worth 670, and we'll give you an 80% loan on it, right? They've come and gone, it's worth over 700,000, and we'll give you an 80% on that. Yep. I've also just changed property managers. I put it with a new property manager. They've given me a fresh rental appraisal, and the rent is going to go up by probably about 15% on that as well. So look, it's a little tiny dip into the market, but that's better performance and better yield, than anything I've got, and I have had for a long time. So having bought that very quickly, I decided that, and it's a kind of a bit out of kilter with what I've been buying, but at least it's a new property, and there shouldn't be a lot of overheads around that. So I talked to Ross, said, look, I'd like to replicate something like the kind of Paddington, Surrey Hills type. Both of them are 2-bedroom houses, terraced houses. And so I said,
so for our non-Sydney listeners, quite inner city,
yeah,
trendier, I think reasonable say.
Yeah,
it's trendy for Surrey Hills. Yeah,
Surrey Hills it's been changing over the last sort of 25 years. It's still a little gritty, but it's not dangerous. It's fairly gentrified. Paddington is kind of, I would say, sort of more proper eastern suburbs. It's quite nice, slightly different. I mean, even though they're only sort of a couple of k's away from each other, slightly different sort of feel to it. So it's kind of, I say I was looking for something similar. Melbourne is obviously not Sydney, right? So you can't just go, I'll look at these type of houses and find them in a completely different city. But it was that sort of general feel. So, like I say, I've known Ross for a long time. Said, Ross, look, are you buying down? They said, absolutely, definitely. So the process, which was quite new to me, was that I talked to Ross, and I'm quite used to a buyer's agent rushing off and then going, here's 5 or 6 properties, which one do you want? But I was introduced to Darsan, who works down there. I had a conversation with Darsan on the phone. Yeah. Then we had a video catch up, and we spent a long time being sort of pretty consultative. And then Darsan went away and took a lot of significant notes on what I was looking for, what my goals were. And I was quite surprised at the process of the thoroughness that they went through, and we had a couple of iterations of sort of looking at properties. And here's the thing, right? Usually I'll get stuck straight into the listing sites, and I'll be doing my own kind of looking around, and the properties that they came up with were ones that hadn't occurred to me, and the one that we ended up sort of eventually purchasing was one that because one I wouldn't have spotted, and I said I'm looking for something that's got land, but potentially with more than one sort of line of income. So it's a pretty unique place that you guys found.
It was definitely, and from that, I think, the importance of having people on the ground. Like Darson is one of our acquisitions managers that's on the ground in Melbourne, and he was an ex-valuer. And, the information that he put together for Alex and I to be able to sort of then discuss, and we would go through it in detail. We would look at the comparable sales. We would look at Alex's brief in terms of the type of style of property he wanted, and then in that sort of consultative approach, we were able to narrow it down to a couple that really suited the brief, and then it was a matter of working out value, wasn't it?
So we again, because it's an important purchase for me, so I rallied a gang together, including Phil Tarrant, whose counsel I always value. He's good with these things. Another guy called Eric Brown, who's done quite a lot of building work for me. So we went down and we jumped in a car and we went and visited all of the properties. The one that we ended up purchasing being first and foremost. But Darson put together they were quite different properties. One of the things that he got me to focus on, he said, to reinforce what Ross was saying, is he was saying, for the type of price bracket that you're looking to buy into, you've got to look at the schools that are associated, as well as all the local amenities. Put a lot of emphasis on the schools, and he showed. He was the first buyer's agent I've really kind of worked with that really showed the change and the shift in price, in relation to the kind of school catchment areas.
Yeah, and it's sort of when it comes to working out, you've got to value like properties with like properties, and on the auction day, we were very lucky, weren't we? Because we set a limit, and our limit, if the property had gone $10,000 more.
So So here's the thing, right? It's a really, really, really unique property. Yeah. My initial brief was I wanted, like a kind of a 2-bedder, maybe a 3-bedder sort of terraced house. But then, again, through Darson's deeper exploration of my ultimate goals and outcomes, dual kind of income became something that was quite important. So the property, and again, Darson said, I've got this place here. It's marketed as a 4-bedroom house, but it is actually 2-bedroom apartments. And it's, what would you call them, a duplex? When you've got 2 houses. They call them a semi-detached house in England, where I'm from. So it's 2 houses side by side on their own separate sort of 330 square meter block, but both of them are 2-bedroom apartments. It's not a 4-bedroom house been turned into 2 apartments. So the agency that was marketing it put it down as a 4-bedroom house. So I think a lot of the people turning up went,
like, what the hell is this?
It's on a nice big, it's on a big block. There's scope, and we talked about scope to add further value. So there's scope. We can add a granny flat at the back, add a third income stream. Yeah. So I would never have found that myself, and I would never have looked for it because my brain didn't realise that was something to do.
And that's what I want to ask. Turning back the clock a bit, you said when you first started talking about the property, you would not have looked at it twice.
No.
Is that because, just when you go on realestate.com.au and you're scrolling through and you're like, you would have seen 2-bedroom unit, you would be like, oh, that's not what I'm looking for, move on next. Whereas in reality, it is 2 semis. It's a little bit more.
There's 2 reasons, right? One, I wouldn't be looking at a 4-bedroom house, so that would never have occurred to me. The second thing is, I wouldn't have been looking at 2-bedroom apartments.
Yes.
So here's the thing with this place. Look, and if you really wanted to, you could go and spend an awful lot of money and you could convert it into a 4-bedroom house, but that would not suit me. But it's on a 300 square meter block. Now, for me, there is potential upside because this place hasn't settled yet, by the way, before we get too carried away. But when it has settled, the first thing that I'll be talking to Ross and Darson about is to find out if the other side which is also on a 300 square meter block, which has another two bedroom, sort of setup, mirror opposite of the house. So that then suddenly, if you can get your hands on, 660 square meters so it's in Prahn, so it's in a pretty prime sort of, it's in a pretty decent suburb,
it's a well-regarded suburb, of the ilks of, like a Paddington.
Similar-ish.
Similar. Yeah.
It's great.
Yeah.
We went and walked around there. We got some food, and it's a pretty cool place to sort of hang around. So it was an odd asset, and so what happened was then you'd got people who come along think it was a 4-bedroom house, so it was probably a bit cheap on this, for a 4-bedroom house on that size block in Prahn. So there's people who came along and went, oh, it's two, and they're both exactly the same. So you'd make a very weird house.
It's probably, of course, it's not gone through settlement. I'm going to guess by the time this goes out, it would have. But it's probably not the wisest listing campaign because, from the agent's perspective, because, like you said, you would neither have looked at the 2-bedroom, you would neither have looked at the 4-bedroom. I mean, what if you've got kids, right? And they're like, you got to exit your unit to go into the other unit to check on the kids. It doesn't make sense.
So what you end up as people came through, and the agent, the sales agent, Alex Whitlock, was a sales agent. They were excellent. They were very, very good at dealing with myself as a potential buyer. They were really good with Ross and his team, and I've ended up I'm going to put that property back with them to manage because they've got an exceptional reputation down there. The property management side of their business is second to none. So it was interesting, but here's the thing: the people who are going to buy it. It was really myself as an investor, who'd got the capacity to buy that at the tail end of my, been investing for 30 years, right? So there's not a lot of people necessarily who are going to look at that as an investment opportunity. The other people that were looking to buy it, there were a couple of brothers, where they were going to have one of the apartments each. But here's the thing, right? It starts getting to a certain rate where you go, well, we'll just go and buy a separate 2-bedroom apartment somewhere else. So, and then on the day of the auction, we talked about, what the price limit was. And this is a really curious thing, which I don't quite know the answer to yet. So the bidding, sort of kicked off. You never know where it's going to go. And it kind of went up and up and up. And we'd set our price and we ended up getting it $10,000 below my maximum. And I couldn't work out whether I was really pleased at getting it. I don't know what's nicer, getting it 10 grand below your max, where you go, if someone else had just put another 10 grand in, they'd have got it and I wouldn't. Or whether you want to get 10 grand above your minimum, and save yourself a couple of grand. But
How do you go about setting those emotional barriers? Because, Alex, you mentioned before about, it's funny looking back to, obviously no one has a crystal ball, but looking back to say some of those purchases in Western Sydney for a couple of $100K, which would probably be worth a fair bit more than $1 million now, right? And you say if it went for $5K over, I wouldn't bid for it. And now looking back, you're like, what's $5,000 if it 5 times value, right? How do you stick to that? Because I think it's one of those things that a lot of people would throw out the window pretty quickly.
Well, you take an advisor like Ross. I think it gives you discipline as well as knowing how to negotiate and why to negotiate. I disagree with the sort of the well-worn phrase that there's no emotion in buying investment property. I think there's a lot of emotion in buying investment property. Sure. It's not the same as buying your own home. You don't have that same vision. But if you love property, which I do, Phil does, you have a connection with it, right? Even if you're going to rent it out to somebody else, you got a connection with the place. And I wanted that place. I liked it. I stood in the garden. Yeah. Everything about it felt right. And I kind of almost made that emotional, and if I hadn't have used an advisor, I may have got dragged further. But then here's the thing, right? And you say going a little bit further, you got to remember that a property is valued today, not tomorrow. So for most of us, you're going to go along and as soon as you've got it all excited at auction, you're then going to go along to your lender, right? And if you got carried away and you've gone $50,000, $60,000, $70,000, $80,000 over the the benchmark's been set, and I've done this before, and then the valuer doesn't see it in the same light. They go, well, we value it at X, and then you've got to find that money yourself, right? So it's a really interesting question. Hindsight's a wonderful thing, but you can only buy and you can only spend what is in front of you right now, and it's going to get valued by somebody else who's going to value it. They're not going to go,
you can only borrow what you can borrow.
It could be worth X in 10 years' time. So, they'll lend you what they will lend you on today.
Yeah. So I think You're exactly right. The way you set a limit is based on what is the market value of the property, right? Because, market and value, right? So you can find better value elsewhere in the market if it goes over your limit, right? And so it's understanding the market and understanding where the value sits, right? And so once you understand that, then it's easy because there's always another property.
Yeah.
We had a perfect example this week where, we weren't prepared to go above a certain limit. We missed out on that property. But the next property, we got an off-market deal. We paid $810 for it. There was another sale in the suburb on the weekend that just went over $1 million. So it was potentially a better deal. We said no to one on the market because the price but we found a better with more value, right? So I think that's the example in terms of understand the market, understand where the value sits. And then once you've sort of made your decision, and we quite often joke because, day in, day out, we have to deal with real estate agents and whether they're telling the truth, sometimes we don't know, right? But our decision has to come down to, do we still think it's a good deal at that price, right? If we think it's a good deal at that price, we proceed, regardless of the spin they're giving us. Does it make sense to purchase it? Does it make sense at that market for that value?
This is the thing this is the difference that agents make though. Yeah. And I know you're very well versed with, with the real estate side of things. You get a good sales agent and they will get a better price for the same property than a bad sales agent.
Oh, for sure.
You know what I mean?
Yeah.
So this is why you as the buyer have to. I need advice. I can't go along and I can do my little desktop vals and we can all go and search on sort of the online, search engines that are there. It doesn't give you what it's actually worth or how a valuer is going to value it. So you need to have someone who is in that market who sees not just that one single view property, but patchworks of them across different suburbs. And they go, there's other ones cropping up. This one's becoming too expensive. We can do better elsewhere. So, it's exactly, Ross, case in point with what happened, just the other day.
Yeah, exactly right.
Now, looking ahead, Ross, I want you to put your coach's hat on for a moment because before you're a buyer's agent, you did a lot of business mentoring.
Yeah.
A lot of people that are listening to this podcast, they're grappling with increased costs of living, just general pressure, affordability pressures that might have stunted their property investing journey. They might realize that they've hit their serviceability cap. They can't get any more. What are some of the most common tips that you're seeing amongst people that you're working with, amongst your friend groups, amongst your networks, that our listeners can fix now to help them get the next purchase done?
Yeah. Obviously, you look after your finances is first, right? So what's your expenses, any unused sort of credit limits, look to consolidate any personal loans, high interest debt, store accounts, afterpays, those types of things, because, by reducing those can increase your capacity by a long way, right? Being finance ready, making sure you've done your tax returns, you've got all your finances in order. Obviously, 3 months before you're buying, think about the expenses, think about what you're spending, and just tighten the purse strings a little bit.
Tax return 3 months before, or just expenses?
I just want to dip in, for people tune in. So talk a little bit about the BNPL stuff. Yeah. How much of an impact is that? When you're going for a mortgage, how much is that considered by lenders? What was that, sorry? The buy now, pay later, your zips and your afterpays and all that type of thing.
Yeah, definitely. So
because this is a relatively new thing, or is it,
exactly. But all of those things, whilst they're easy to get, they're going to affect how much you can borrow, right? Because they're going to be factored into your serviceability. So, if you can reduce those, it makes a big impact, right? And even credit card limits, unused credit, because people have them for rainy day.
And that's the thing, right? Even if it's unused, if you've got a limit of 20 grand.
Yeah, even if it's unused. So though all those things come into it. Obviously, once you've looked at your serviceability, and some people sort of hit their serviceability caps, and some other ways that you can get around serviceability caps is to think about, a self-managed super fund. They're not right for everyone, so you need to seek the right advice from, accountants, financial planners, etc. But it is a good way that you can potentially access further property in your portfolio by leveraging into a self-managed super fund is one option that people can consider. In terms of, for certain individuals, a trust structure may be the way to go. But again, it's getting the right advice in terms of what is going to be right for you. For certain people, it may be looking at commercial property, right? If they've been investing in residential property for a while, because there's products like lease stock products in a commercial property. So that's from a serviceability. From a deposit perspective, obviously, there's some different options where, a lot of people think they need 20% deposit. That's not the case, right? You can borrow an investment property and leverage up to 95% these days. There's family guarantees. So if you've got parents who have equity in their property, they can give a limited guarantee where it's not for their whole, but it's, for the 20% deposit where the child borrows the full loan amount, and there's a small guarantee. But what that means, they don't need to save a deposit, right? So for my son's turning 18 tomorrow, I'll be encouraging him to get into the market, and I'll be encouraging him to go ahead, and I'll put one of my investment properties up, and he can get into the market as soon as he possibly can. So for any parents listening, or children who know that their parents have a portfolio or equity in their home, that's definitely a good way for them to get into the market quicker.
Now, Alex, what's next on your investing journey?
Well, funnily enough, there's probably going to be the end. Oh, I say this.
You can't say the end. You're on a property investing podcast.
The end of my residential journey. The problem is, I just love, which Ross and I were talking about last night. I love property. I love residential property. So Phil's very much an advocate of going into commercial, and that will probably be where I'll look to go. But I can't get excited about commercial property. It's just something about residential property.
It's less sexy.
Yeah.
But, I mean, it's important as for all the reasons that we identified earlier. You've got a better yield, or at least some better cash flow as a result. I don't really know much about commercial in terms of sort of growth in the asset, but I know that the yield is very attractive. So I think next for me will be to take stock of what I've bought. I've taken a fair bit of pain in my purchasing. I've sold down properties in suburbs that have in Brizzy. Pre-boom and redeployed that capital into certain, into Surrey Hills and Paddington and Avalon, which haven't gone anywhere. So I'm hoping that I will see the capital appreciation in those suburbs moving forward. And then obviously, with the place that we've just secured, I mean, it's going to be a kind of a long sort of burning campaign there, but hopefully I'll see the appreciation. But I think, next will be commercial, but I can't get excited about commercial. I'm sorry, not the same way as I do about residential. It's just, I just love it. Oh, it is heartbreaking. Do you work in commercial as well, Ross?
Yeah, we've just started a commercial side of the business as well. My brother Scott, who partnered me in the mortgage business, is heading that up. So yeah, that's an exciting new venture for us.
Oh, well, fantastic. If anyone wants to reach out to Ross, how can they reach out to KHI?
Yeah, so it's KHI Property Partners. So if you look at khipartners.com.au, go to the buyer's agency section and you'll find our details.
But that is all we have time for today on the SBI show, and we'll be back shortly with another episode. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.